Here with me is Samantha McLemore, founder and chief investment officer of Patient Capital Management. Welcome. It's great to see you.
Great
You
to
worked
be here,
with, as many of our viewers know, Bill Miller for 20 plus years. You've now acquired the Miller Opportunity Equity business this past May.
Correct.
Okay.
Yes, correct.
Welcome. And TV debut.
TV debut.
And what a day between our technological gremlins and the gremlins kind of plaguing the market. So this doesn't surprise you, the fact that we're a little bit of tough sledding out there, but you think it's priced into some stocks already. Is that right?
Absolutely, Kelly. And I think the main thing to note is just how resilient the market's been in light of rates and oil and all of these headwinds that would have taken the market down much more last year. We're only down 8%. That's a normal, natural correction. And
after a run-up that surprised so many people with its strength and vigor, I was thinking about you earlier this year, one of the stocks that you had long had your eye on was Delta Airlines. At one point, it was on a 16-day win streak. And then along come higher jet fuel prices, and it's staged a pullback. But you still think there's a lot of room to run there, if I'm not mistaken.
I think Delta is extremely attractive. I think it's underappreciated quality. This is a premium brand. Airlines are not like they were 20 years ago. There's been a lot of consolidation. There's capacity constraints with pilots and with equipment. And Delta has a 15% free cash flow yield.
Wow.
And it earns mid-teens returns on capital. So this is not a company that should trade at 5 times earnings.
It's $36 a share now. If I recall, you think it's more, something in the 70s would be fair value?
Yeah, and I actually think it can get to over 100 5 years out.
Wow, 5 years out. That's going to be an interesting 5 years between GDP and the deficit and yields and whatever's happening. Let me just ask you big picture for a second. Do you have to change, a lot of the stock picking the past 15, 20 years has been in a very low rate environment. We are not in that anymore, and it seems to be changing day by day. I don't know if that's kind of changing the way that you work.
We're always long-term. We're always focused on where are the best opportunities on an intrinsic value basis. I think we've had the worst period for value investing ever in the history through 2021.
Right.
Worse than the tech bubble, worse than the Nifty 50 period of the late 60s. I think those negative real rates were an important factor in why that existed. And now that we have higher real rates, that favors a lot of companies that are generating cash flow in the here and now. So I think it will help value continue to outperform.
It's fascinating. And if you stuck with the business through the last 15 years, then, this maybe is a welcome change. One of the other names, there's a couple of names, a little bit more on the financial side that I think people might be surprised. One Main Financial, right now we're talking about the deterioration in some subprime areas of the consumer. That's kind of their bread and butter. Why does this stock jump out to you?
You hear a lot now about how attractive yields are, and people can get 5% in cash. Kelly, I know you like treasuries.
Yeah.
So I think One Main, you can get over a 10% dividend yield that we are confident is secure in any sort of economic environment. And once we get through the fear, through a recession, and people are more confident in a recovery, we think that stock can double. So we're seeing attractive opportunities like that.
10% yield, and you're not afraid that that's a fool's yield, so to speak, where they're not going to be able to sustain it, the cycle's going to turn, and they're heavily, exposed.
No, that's often a risk you take when you are investing in yields that high. But we think the stock's trading at 39, even in a financial crisis type recession, they can earn $4 a share. So they can cover that dividend yield in any environment.
Putting your neck out there. Now, again, we've seen Bill, he's not been afraid of controversy over the years. Citigroup is another stock. I do want to mention this one because speaking of things that haven't worked well the past 15 or 20 years, why do you think now is really a change for this company and for this stock price?
Yes, I think Citi is underappreciated, under-recognized, and very undervalued. This is a company that's been mismanaged and has a huge bureaucracy for decades. So people are rightfully skeptical. Again, you can get a 5.3% dividend yield here, and Jane Fraser is making all the right moves to fix the business. She's selling underperforming businesses. She's taking out bureaucracy and layers of the organizational structure. So the stock trades at 40, and it has a tangible book value in the 80s, which we think is going to grow to 100 over the next few years. We think as she gets that return on tangible capital up to 11 and 12%, which is not heroic, that it'll trade much closer to that tangible book.
It's tough to bet on stocks where history has not, favored them. But again, so Jane, by the way, Jane Fraser will be on CNBC Friday morning, 10 a.m. with our own Sarah Eisen. We look forward to more comments there. Joining her from the, I think the TMT summit that they're holding. Before we go quickly on Expedia, is this just a travel play? I mean, there's been a lot more plaguing the stock as well, competitively speaking.
Yeah, no, it's not a travel play. Travel is obviously booming, and people are prioritizing it after the pandemic, but this is a company that made major improvements to the business through the pandemic, integrated their tech stack. We think you're going to see big margin improvement over the next few years. They've bought back 8% of the shares over the past year, so they're returning a lot of capital. Again, a 15% free cash flow yield. It's a free cash flow machine, and we think very underappreciated.